Greetings, trusted clients and friends. I am GK, your trusted financial advisor. And today I want to take you through investment review. It's June, end of quarter. You know the thing go. So let's go. All right. So of course, this investment review has to do with two things: your equity multiplier and your Sagi-Gold. And your other investment, like a guaranteed investor and premium saver, those investment returns are fixed and set, and me now in the business are going to update on those. So, 4.5% thereabout. Now, just a quick overview of the equity multiplier, and I'm doing this so that you have a reminder of what your policy is about. So the equity multiplier is an equity-based investment product with units into the company's segregated funds. So the company have these funds that your money go into. I'm going to explain this in a few, but just giving you a quick overview. The equity multiplier is very liquid. The funds are easily accessible. It's suitable for the short term because, of course, you have access to the money, so that is good. So for those short-term goals, perfect. Mwah. Now, it is also good for lump sum investment. So if you have a piece of food that you get from somewhere, whether it be life insurance proceeds or your work get a local bonus or they're gonna give you some back money, you can throw it yourself. All right. And also the payments are flexible, meaning that you don't have to have a set payments on a monthly basis. And so this is good for like emergency funds, etc. Right? Now your Sagi-Gold is a little bit different. The primary purpose of the Sagi-Gold is to what? Accumulate money. That's why they called it the Sagi-Gold Accumulator. Sagicor, gold, money, accumulator, because you're going to build brick by brick. And so every month or every 6 months when you pay your premium, you're actually accumulating money as you go by. So it is good for many future things, whether it be a home purchase, home acquisition. It is that. The difference between the Sagi-Gold and the equity multiplier is that the equity multiplier, the payments are flexible. The Sagi-Gold, the payments are set. So if you start with 20 grand, if you start with 30,000, if you start with 50,000, we keep it at that, and you must pay that $50,000 on a monthly basis. But remember, we set the Sagi-Gold because all right, we need to have $2 million within the next 2 to 3 years or whatever it is, and so we have this set amount that we set aside monthly. It's normally a sacrificial thing, but it is good, and most of my clients have used it for your house deposits, their children's education, but it can also be used as a retirement supplementation, not a retirement plan, not a pension plan. It is used as what? Pension or retirement supplementation. Remember that. All right. Now, let's look briefly at what segregated funds are. A segregated fund is now a pool of investments similar to a mutual fund. What is a mutual fund? A mutual fund is, think about you have a big swimming pool and you throw all of the different stocks them in there, and so when you jump in and just swim around. Yep, that's pretty much what a mutual fund is. It's just a pool of investments. So it can be a pool of stocks, a pool of bonds, a pool of various things. It all depends and will vary from company to company. Now, how this works out for you is that instead of buying one stock, you buy into a group of stocks. So you not just buy, one banking stocks, for example, Bank A, but you're buying Bank A, Bank B, Bank C, Bank A, B, C, D, E, F, G, H, I, J, L, M, N, O, P, P. The whole works. Now, what happens is that your fund is broken down into units. So you have $100 million invested in this. Each fund is broken down to a unit, and each unit has a value. So let's say that one unit is equal to, because remember, we have various stocks, and just combine this and say, all right, this will equal to one unit. And then they will ascribe a value to that one unit. And let's say that unit is now valued at $100, right? So what happens is that every time you pay your premiums, you're actually buying more units, and every time you withdraw from these policies, whether it be the Sagi-Gold or the equity multiplier, you're actually encashing your units. Get that? But remember, the units fluctuate with the market, and so what we want our units to do is actually increase in value. So that is very important. All right. Now, the types of funds that we have at Sagicor are 6. So we have the money market, we have the international equity, we have the balanced fund, and you have the equity fund, we have the fixed income, and we have the US index. All right. But Not all funds operate the same. So now let us now look at our fund performance, right? And year to date. So what I'm doing is that there's a whole lot of figures that are not present here. So I've just taken out the key figures. So if you look at where we are here at in May, we have May, and we're comparing May to the previous years. And I'm looking back for at least the last 3 years for December 2021, December 2023, and December 2024. And we're just going to take a quick general look. So now, as I said to you, there are 6 funds. There's a balanced fund, there's an equity fund, and there's a fixed income fund. I'm going to divide these into 2 groups and just let you have an idea of how they perform. Right? As we can see, the best performing fund over the last 3 years would have been the international equity, and it will have given a high of 13%. So if you have 100 grand in your investment, you should earn around gross of around 13%. So that's 13 grand for every 100,000 that you have in your investment. It doesn't necessarily work like that based upon charges and a few things, but it is part of. I'm just giving you general figures because every investment has some charges to it, but we're not going to go into that now. What you care about is how this thing has been performing for you. The next best performing fund over the last 3 years on average would have been the US index, because we see where that would have given like 11%, 12% per year, except last year, where last year it gave 5%. And last year it would have been one of the lower performing funds compared to the others. But it's the nature of investment. Some years are better than others, but you realize that like your equity fund ended last year at just 5.8%. This year it's still negative, but there are some things to look at and to talk about. But don't worry about that. I'm going to give you the necessary breakdown that you're expecting, and then we take it from there. So once again, we are here now looking now at the different fund performances. And what I want to show you here now is just 2 things. So on the right of your screen, we have the performances. As I said, these for me are the lower performing funds, and I call them lower performing funds because the ideal thing is that to keep your money abreast with inflation, you need your money to be performing anywhere at minimum. Inflation is supposed to be between 4 to 6%. So the ideal thing is to ensure that your money is performing above that 6% margin. Now for me, and based upon these funds, they are okay. The performance is okay because 5.6% based upon the current market is okay. And we're looking at last year's figures right here. If you look at December 2024, 5.6 for the balanced fund, 5.8 for the equity, and the fixed income was at negative 1.30. We don't like that. I don't like that. So there are some things that we want to look at here. The equity fund is trying to come back, but it isn't quite there as yet. So it is a highest performing fund that we have had over the last 10 years. So if you take out the years from COVID-19 coming up, beautiful fund. But from COVID-19, I really know what I'm going for my friend. Me I try calling to see if he can resurrect, but it's just been steady, and the market has been trying to recover since. Now, what should you do if you have your money in any of these funds? Well, first and foremost, none of my clients have money in the fixed income. So I would definitely say to your client, get their money from the fixed income. And we're going to look at things like, if you want to go balanced fund, yeah, it is good, but I wouldn't recommend it, especially for clients with the Sagi-Gold, because we are trying to maximize returns, right? So what I'm recommending is that if you have money into like the equity, you can hold, because you would continue to buy the funds at the lowest price, which means that when the market go up, you profit big. But I can't tell you when that is going to come about. I'm going to customer and say, oh, GK, the fund not perform because of that. So we have the option now of actually reducing the risk by actually either switching over to completely to different funds, or we can diversify and say, hey, let's have a percentage of our money into the equity fund versus into the other funds, like 20, 40, 50 kind of percentage mix, that kind of thing. But of course, that kind of assessment is going to be on a one-on-one basis, because each of you have different risk appetite. This presentation is just general so that everybody can have an understanding of what is happening. All right. All right, so let's go now. So now I'm looking at my preferred funds, and what are we seeing here? All right, so first and foremost, I like these funds because they are producing double-digit growth or consistent growth, no negative returns, nothing like that over the last 4 to 5 years, which is what we want. We want a continuous growth. We want to know so the money is always trending up, never down, right? And so let's take a look. So for the client who have selected these funds, you would have seen anywhere between 5 to 10% net growth within your portfolio. We don't know look on the figures them. If we not see these figures or this kind of growth on your Sagi-Gold and your equity multiplier is because the monies are not allocated into these funds and they're allocated in the previously funds in the previous slide. But we're there, we change that, right? So here's what we are looking at. So the best performing fund, as we can see here, is the international equity because that has just been consistently above 10%, and that one because if inflation is expected to be between 4 to 6, and we can see here where we over the last 3 years we get double that, it means say our money is actually keeping ahead of inflation. Remember, what inflation pretty much does to your money is it says that $1 million today is definitely not $1 million tomorrow. If inflation is at 6%, you need for every $100 you have, you need $106 tomorrow to equal the $100 you have yesterday. But with this kind of investment, your money can still be the same $100 because guess what? Instead of $106, your money is $112, for example, or $110 or $109. So you can buy $3 more goods this year than you could have purchased last year, just generally speaking. We all know that inflation is a little more tricky than that. We're not going to go into the details, but yeah. So what do we look at? What are we seeing here? And why are these my preferred funds? All right, so if you look at the US index, as you can see, it has been continuously positive. For the last year over, it was in double-digit growth. 2020, double-digit growth. 2021, double-digit growth. 2023, but last year it was single-digit growth. There are some factors to consider regarding that, but we're not going to look at that. Those factors are still present, but as you can see, up to May of this year, it's at 3.7%. And when I look at the history of the products of the performance and what we use to determine what we do in an investment is actually the history. So look at the history of what takes place in our investment. And I saw we're around this time back in 2021 and 2023. This was like the similar growth pattern. Last year was a little bit lower, but this year is a similar growth pattern, which means that it is a potential, not forecasting, not predicting, but it can be that it is likely to be around there if it continues on the same trajectory. I'm just telling you what the figures are, not making no promises. The figures can vary from reality. That's the US index fund. Remember, all these monies are in JMD, so don't ask me if it is winning them. Tell you there's a different presentation to explain the basics of each of these funds. What you want, if the money are perform, yes or no, and that may I tell you. Now, when it comes on to the money market, things are a little bit different, right? And I like money market. That's one of my safest funds because, oh my God, I don't want to go into the details of you, but just understand that each of these funds have different kind of mutual ingredients, as we call them. So mutual funds, money market now will be more like government bonds or short-term debt instruments, and so those returns are due in shorter period, and so the return is kind of sure. You'll find that your money market will give you anywhere between 5 to 6%, 7% on a good year. Last year it ended at 4.2%. I understand that because the US money market thing, which is also similar to that, never does so wonderful. You realize that the money market kind of things, the money things kind of is similar last year. And so it is a fraction of its high in 2023 at 7.4%. But it's still good, it's still safe because what it says to us is that me not lose the money, right? And this will be good for like your equity multiplier. If you're like using your equity multiplier as an emergency fund, it's just good for us. Dump the money in the money market because it is safe, right? Relatively. It can decrease, but it is normally, as far as I've seen, it's relatively safe, and that's why money market are tend to be favored. We look now at the international equity and we realize that, yo, that is the fun because that'll give you the money we want to get. So, but it is high risk. I say this to you now, it is high risk. The US index is medium to high risk because it is a foreign currency linked market, and so we don't have much control over that. And the equity in general is normally, as they say, high risk, right? But remember, in generally, a mutual fund is, even though the equity is high risk mutual fund, it is not a higher risk as buying the individual stocks. You get that? So it is a lower risk, but in terms of comparing it against fund, it is higher risk. All right. So matter the equity fund where dropped 20% in a back between 2019, 2020, and 2021. Some really tough years went on for those. So what do I recommend now? So it is my recommendation when it comes down to these things is that the most stable performance is the money market. So if you're looking at stability, I would recommend the money market, but understand that your returns are going to be limited to single-digit growth. So if you have money into these funds, you can hold it, meaning that we make no changes, or we can switch it up a bit to ensure, say, we actually increase the income. I may have a look at formula. I'm not going to tell you what the formula is because I'm supposed to reach out to me and have the conversation. I saw this thing go. It's conversation. So yeah, getting the information, but you better call GK if you want to know how this thing actually works. So we can switch up the funds a little bit, mix up here and there. I'm not going to tell you what the recommendation here is, but as we progress, we know what is actually next. All right. So the next step now is to actually facilitate just the change of the fund allocation. So you don't have to buy a new policy unless the current Sagi-Gold we have is low. You don't have to do that, right? What we can do, however, is to just make some changes. So you can just send a request to GK, the trusted advisor, at granvilleknight@sagicor.com. That's granville_knight@sagicor.com. But one of my clients, and I'm supposed to have this, just respond to the email I'm going to send you now, or the email that I have sent to you guys with all the information. Please, let's go, right? And the fund performances are not necessarily guaranteed. I just wanted to remind you that we are allocating money based upon market conditions and current fund performance and also historical performance. Now, as a market change, we have to just watch the market and make some adjustments accordingly. But I know some of you haven't been pleased with the returns, and as I said, the problem is that how the monies are allocated. So help me to help you. Sleep on it, decide on it, and then we take the next step come tomorrow. I just want to give you some general reminders. First and foremost, me and a financial advisor don't go around and talk to people and I say, oh this, oh that, and let them tell you all sort of stuff. I don't know how for them advise a cook or how them structure them portfolio, so I can't advise on why their portfolio isn't working. So I'm a financial advisor. When it comes down to products, you can talk to me. You can double check with the brochure that I will send you. All those stuff. Make we talk. We see the figures them me not growing up. Me get them from Sagicor, and as some me get them, as some me are going up. Yeah, true. Now remember, annual reviews ensure the best performance. If you're not sitting and not talk to me, or not take me call, for no business that. But me I try to do my best. Work with me. We sit down, we talk, review. Yes, naturally. If there's a gap in your portfolio, I'm going to try and meet it. But work with me. And of course, clients, please. You see, if you send me on a friend and a co-workers them who I make the money or who I make the same amount of money as Ono, that works out so much better for me because now I get to service a group of friends instead of me try to look new clients every day. If Ono look the clients them for me, it work out better. So please, when you see this presentation, I ask 5 clients who feel like can benefit from my financial expertise, and we're good to go. I also want to thank you, just let you know that you're appreciated. I appreciate everything that you have given me. You have been my #1 clients from day one. Love you. Love and light. Remember, success is yours, and if you need insurance or investment, you better call GK.